Welcome, everyone. We're so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management. Today's session is part of a multi-part series called Laying Your Financial Foundation, where we review the important fundamentals for saving and spending when you are in your 20s and 30s, and demonstrate how your financial success will depend on more than just a good income. Today, we are reviewing credit and how maintaining a good credit can impact all aspects of your financial life. We will also look at managing student loans and other debt and the best way to approach paying them off. While each of your financial situations are unique, there are certain foundations, including maintaining good credit and managing debt repayment, you all need in order to start the path to financial success. If you have any questions at the end of the presentation, please contact our office. We also highly recommend checking our webinar library at jfltotalwealth.net/webinars for additional installments of the Laying Your Financial Foundation series. We will be reviewing budgeting, saving for retirement, insurance protection, and how much you can expect to pay for big expenses like your first house or a baby. You can also download copies of these presentations on our website. Without further ado, let's introduce today's speaker. Jeannie Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. She has a 20-year-old son and a daughter headed to college this fall.
Good morning. Thank you for joining us today.
We know that each of you has a personal view of what success might look like for you as you get older, have families of your own, and reach career milestones. Our goal during this series is to provide you with the background on the topics listed here so you have the foundations for financial security at every stage of your life. Today we are talking about credits and loans. Jeannie, take it away.
Excellent. Thanks, Gretchen. Let's go ahead and start off by talking about credit. Now, your credit report and credit score, the two things you've probably heard of, they're related, but they aren't the same thing. Your credit report, that's a summary of your financial and credit history. If you've ever applied for a job, that employer might have asked you for references to find out if you're a good person or you're going to be a good employee for them. Think of your credit report as a credit reference for you. Are you a worthy credit risk? There are three credit bureaus that collect data on you. There's Equifax, Experian, and TransUnion. And each of them maintains a credit report on you. Now, you're able to get a free credit report for each year from each of these agencies. You just need to go to annualcreditreport.com and download your free copy. So what we want to do with that, that's something to actually be able to go on there annually. We want you to go and download that and take a look and see, is my payment history correct? Are the number of accounts that I have open, are those all correct? Is there all the information about me? Is that right? Because it's really good to kind of keep track of it. It's easier to fix right away than waiting for several years to try and correct something. You also have the option of doing something called a credit freeze. You do this at each of the three credit bureaus. What this does is that this blocks new accounts from being opened in your name. It's a really good thing to do for fraud prevention. So, but if you want to apply for a mortgage or maybe get a new credit card, all you have to do is have the freeze lifted. Once you're approved, put it right back on. Now, your credit score. This is an algorithm. This converts the credit report and the information that's gathered there into a number. And there's several companies out there that create them, but FICO is the most common. Now, you can find your credit score on your bank statement or even on your credit card statement. Now let's go in a bit more depth into what goes into your credit score. So your credit score, this is a complex mathematical model that evaluates different types of information to determine your credit risk. Or said another way, how likely are you to repay a loan and how likely are you to make those loan payments on time? And it's comprised of 5 different factors. The most important of these and the most impactful would be the payment history. Do you pay your bills on time? Are you paying them late? If you're paying them late, how late are you? The amount you owe. There's something called a credit utilization rate. And this is how much credit or debt that you have and that you're holding relative to what's available to you. and you want that to be less than 40%. The length of credit history, how long you've had those accounts. Again, the longer the account's been open, the more history they have on you to understand whether you're paying on time or not. New credit. Are you someone who, when you go to the store and the clerk offers you to save 20%, you sign up for this new credit card? Well, the more frequently you do that, the more negatively that's going to impact your credit score. And then the types of credit you use. So if you have experience managing different types of credit, say you've got credit cards, maybe some student loans, maybe a car loan or even a mortgage, the more varied options that you have of credit, that's actually going to be impactful, and it's going to be a positive thing to show that you can manage those different types of credit. Let's go a little bit more in depth into the numbers. So the number in the lower left-hand part of the screen here, the 695, have any idea what that is? Well, that's the average credit score in the US. So how do you know if your credit score is any good or not? Your credit scores can range anywhere from 300 all the way up to 850. And the higher the score, the more trustworthy creditors think that you are. So why is this important? Well, it's important because a poor credit score could mean that you end up paying really high interest rates on your credit cards and loans. You might have to even put a deposit down to open up a JCP&L utility account. If you have excellent credit, that's going to be the opposite. That means you're going to be able to borrow money at the lowest rates available. And your credit score, it's not some fixed number, and once you get it, it's there forever. It changes over time. So for example, maybe 2 years ago, your credit score was 800. But then you lost your job and maybe you had a hard time, keeping up with your bills. It might have dropped. So the credit score really is going to accurately reflect your current financial behavior. Now, if you do have anything negative impact your credit score, it's going to stay on there and it's going to have an impact for at least 7 years. So let's take a look and see kind of how it potentially would impact a loan. So here we're looking at a $200,000 loan or a 30-year mortgage. And we have two different credit scores here. You have 625, that's decent, it's okay, a little bit lower than average. The loan rate that you're going to get there is 4.125%. Now, if we look and compare that to a credit score of 750, that's really pretty good. Now, the difference in interest rate there, that's about 0.5%. You may not think that's not a big deal, but over the life of a 30-year loan, that 0.5%, you would end up paying more than $20,000 more for that same loan. So let's take a look and see some things that you may do inadvertently that would lower your score. If you pay your bills late, or if you pay less than the minimum, that's going to lower them. If you use too much of the credit that's available to you, that credit utilization rate that I mentioned earlier, you want to keep that less than 40%. If you start getting higher than that, that's going to have a negative impact. You own lots of credit cards, that will do it too. And if you don't keep your personal information consistent and up to date. Now, say for example, you have a middle name that you use that you go by, but then you also have your legal name. And if you open credit under those two different names, your full credit history is split between the two, so it isn't fully captured. You want to make sure that everything is, again, consistent and up to date. And if you don't establish credit on your own at age 21, so prior to that point, your parents were involved. They might have co-signed on your student loans or helped you open a credit card. After 21, you're still, if you don't do anything, you're still establishing credit and a credit history, but it's not your own. You want to make sure that you start building it on your own, open your own credit card, and so that you kind of start establishing that history as well. Now, there are things that you can do that will help you increase your score. Again, you're going to pay your bills on time and do that for a period of time. You're going to pay more than the minimum amount for payments. You want to keep the number of credit cards that you have kind of to a minimum. If you start opening a bunch of credit cards in a really short period of time, that starts sending off some red flags to the credit bureaus. You also want to pay down your credit card debt. I know it can be enticing to kind of shift your credit card balance from one card to another card, but in a way to improve your score, you really need to start making a dent into the balance that you owe. And again, review your credit report on an annual basis and catch any mistakes if they exist. And then one thing to keep in mind too, if you closing out a credit card, and that's not always a good thing. It may make sense to keep them if you only just have a few lines of credit available to you. It may make sense for you to keep that small number. So we've talked a bit here about kind of your credit report and your credit score. Let's shift gears and focus now on student loans. So one of the questions we get asked a lot is, should I pay off my student loans early? A few situations where that's going to make sense. The first is if you already have your emergency fund set up and funded. Now, emergency fund is 3 to 6 months worth of expenses set aside, to cover any sort of unexpected car repair, or say you've lost your job, to help kind of tide you over for a period of time. And if you don't have one, or if it's not fully funded, you shouldn't start paying extra down towards your student loans. If your student loans have high interest rates, if you're paying a lot more in interest than principal and you've got some extra, you may want to start paying a little extra each month towards your student loans. That would be a good option. And the third situation, if you've already started saving in other ways. So if you've already started saving for retirement, or saving to put for a down payment on a home, it may make sense to put a little bit more towards paying off your student loans as well. Now, there are situations where we really want you to hold off before you start putting extra down on your student loans. If you have lots of credit card debt, credit card rates can be significantly higher, and you may save more money by paying off your credit cards first than if you focused on your student loans. And then if you don't contribute to your 401k, and get that employer match. So even though you have student loans sitting out there and they may be weighing on you, you still need to start saving for your retirement. The money you save today is the most powerful money that you'll ever save, because it has the longest period of time before you retire, so it has the longest time to grow. So if your company has a 401k and it has a match, you should contribute up to that level of the match before putting any extra money towards your student loans. For example, if you make $50,000 a year and your company has a 3% match, you're going to want to make sure that you put in $1,500 into your 401k. Your company is going to put in an additional $1,500 in. You've just earned 100% return on that money. It's a really good thing to do. Now, there are a couple different strategies for paying down your debt, or paying down student loan debt. Two schools of thought. The first is the avalanche method, and the second is the snowball method. The avalanche method, you're paying down debt and you're focusing on the debt with the highest interest rate first. You pay the minimum for all other debts except for that one with the highest rate, and that's where you focus your efforts in paying that one down. Overall, with doing this method, you're going to pay less interest overall, and you're going to be able to pay off your debts a little bit sooner. Now, the snowball method, this focuses on something else. Here, you're focusing on the account with the smallest balance first. You pay the minimum again for all other debt except for that account with the smallest balance, and you pay that one down as much as you can. And here, you're building momentum. It can give you a sense of accomplishment. Hey, I used to have 4 debts, 4 loans. I now only have 3. I now only have 2. It gives you a sense of accomplishment. There's no real right or wrong answer for these. It's really what gets you motivated and keeps you focused on paying down your debt. So another question that we get asked a lot is, is graduate school, is it really worth the cost? In some careers, it's an absolute requirement. You need to get that advanced degree, while others it might be a nice to have. You need to make sure that you do your homework before you apply. And it's expensive. Let's start off with that. College was expensive. Grad school is going to be expensive too. You can look to spend anywhere between $30,000 to $40,000 a year in tuition, but that doesn't even include your cost of living. There's also the opportunity cost. Does the increase in income and job growth potential for you, is that going to outweigh what you lost in wages and savings while you were in school? You might want to look at an executive program or even a part-time program that would allow you to continue to work. And the other benefits doing that, not only earning money while you're in school, but also you could find out if your company might be willing to pay for some or all of your tuition. And then how long do you want to pay off your loans for? If your income coming out of grad school, if that's more than your total loan balance, you may be able to you're likely to pay off those loans in about 10 years or less. If your income's going to be less, paying off the loans could take significantly longer. Let's talk about some best practices for paying off student loans. If you've got stable income and some credit history, you might look to consolidate or refinance some of that debt. SoFi.com, Incredible.com are websites can give you information about that. So if you get a raise, a bonus, or even if you get some, get that tax refund back, take some of that and put that down toward paying down your student loan. And you also want to look at talking to your employer to see if they can help you pay down your loans. A lot of employers aren't even available to just know that this is an option to them. Some companies have some formal programs, but again, most don't. And your current employer may not know that they can pay up to $10,000 to help you out. You as an employee, you don't receive that money as taxable income, and the employer, they're going to get a tax deduction. Now, the CARES Act, that came out earlier this year. One of the provisions within that was to be able to defer federal, and this is only federal, defer those federal loan payments through the end of September 2020. So your payments, they're not going to go away, but they do get tacked on at the end of the loan. So, but if maybe you've lost your job, if you need a little bit of help during this time, it's a nice option to have to maybe be able to defer those for a period of time. So we want you to have kind of 3 key takeaways coming out of our discussion today about credits and loans. The first is that credit score. It's going to follow you for the rest of your life. And any bad decisions that you make, those can have a lasting impact on your ability to get good rates for many, many years to come. And for your student loans, we want you to develop a strategy to pay them down. Decide what you prefer. Do you like snowball or avalanche? Just pick one and stick to it. And then we also want you to review your credit report every single year. You want to make sure to catch anything that's wrong and get it fixed right away. And then in general, overall, throughout the series, we have some best practices and some tips for you. The first of these is we want you to live below your means. We want you to develop good spending habits now because those are going to benefit you for the rest of your life. The second would be to take that bonus or raise, and put some of it into savings. We want you to celebrate. Take part of it. You may even look at it and say, half goes for me to celebrate, half is going to go into paying down debt and saving, because you do want to celebrate life's accomplishments. The next thing we'd like you to do is automate. This makes it easy to save. It can be done automatically, and you don't even have to think about it. It's also really important for you to get your estate documents in order. You may be surprised to know that your spouse or your parents don't necessarily have the ability to make medical decisions on your behalf if you can't do them for yourself. And you need to have something called a medical power of attorney to be able to do that for you. And then finally, we take a look at the Roth accounts. This would be the Roth IRA and Roth 401k. These are after-tax retirement savings accounts. So you pay the taxes now, and then the money comes to you, or you don't have to pay taxes ever again on any of that money. And you're most likely today, you're in the lowest tax bracket that you're ever going to be in. So it's a great opportunity to pay those taxes and never have to pay them again.
Thanks, Jeannie, for that great advice about properly managing your credit and student debt. If you have any questions or would like to speak with Jeannie about your personal financial situation, please contact our office. And be sure to visit our website where you can view other key topics for laying your financial foundation. Thank you for joining us.